Welcome back, everyone. It's Jay from Investonomics, and it is lecture time. This week, we're going to be covering portfolio diversification, and this is really important in investing. So, this is going to be the second video of the investing series. So, I hope you guys enjoy and can learn something for your own portfolio, and I'll see you all next week. Welcome back, everybody, for another weekly lecture, and this week we're going to be covering portfolio diversification. Diversification is a commonly heard term in finance, and it's used all over the place. And nowadays we hear it all the time on life hack videos, or as they're called, on Instagram or TikTok. Today we're going to straighten out exactly what it means and how we're going to use it for your personal finance to better it, and make sure that we know the difference between the TikTok version and the real version. So it's an enormous concept overall, especially in regard to hedge funds and pension funds, which constantly are working to master the art of diversification. And this means they're going to keep working to make it better. So when it's used properly and efficiently, diversifying can help to limit volatility or risk, as we've talked about, in a long-term portfolio without having a large effect on the return. And again, this comes back to the Markowitz from the first finance video. So the main idea is that if volatility is minimized, swings in the market will not wipe out much of the gains, which will compound over time as they're kept. This leads to an exponentially larger nest egg in a few decades. So the key is that it can be fine-tuned in order to eliminate certain market risk factors that affect performance of the long-term portfolio. And this is key, we'll see in a second here. Diversification in its simplest terms is selecting securities such as bonds, stocks, ETFs, short-term investments, and TIPS, as we'll see this later, this is very important, in order to minimize the overall risk. So there's 4 specific market conditions that we need to diversify for accordingly. And there's 4 categories here. So I'll make a nice little diagram here to make it a little bit simpler to follow. So the 4 that we're going to be talking about here include rising growth, or an expansion in the economy, rising inflation, which is increase in printed money, falling growth, or like a falling in GDP, and falling inflation is also known as deflation. And right now we're actually in a rising inflation period with COVID-19. So the rising growth sector involves gold and commodities that are good in this type of environment, stocks and ETFs, as well as corporate bonds. When there's falling growth, government bonds do well, and TIPS, or inflation-linked securities, do well as well. Now for rising inflation, like we're in right now, gold and commodities do very well, and the TIPS again. And when there's falling inflation or deflation, it's government bonds and stocks and ETFs. So TIPS are very similar to bonds. It is an acronym for Treasury Inflation Protected Securities. Normal bond yields suffer due to inflation normally, but TIPS incorporates it so that the yield of the bond is unaffected. And this is really important because we don't want to pay for the inflation. Stocks, as it's commonly known and is pointed out by quite a few number of hedge fund people, are 4 times more risky than index funds or bonds. This means that individual stocks should be a small proportion of your portfolio. Overall, it's a balancing act though. Too conservative of a portfolio, which means less risk, means your nest egg may not grow enough to overcome inflation over time, but too aggressive or too risky may subject you to too much volatility and wipe out your returns as well. So we need to be right somewhere in the middle between too conservative and too aggressive to have a growing portfolio. So diversification should be done over 5 main asset classes, and there may be a couple more as well. So these are the 5 that I've identified. So stocks and short-term investments, which should be the smallest proportion, ETFs, government bonds, corporate bonds, and TIPS, or Treasury Inflated Protected Securities. So the first we're going to look at is stocks here. So all I'm going to say here is that we generally want to keep small proportions of simple companies that you believe in. So if you have 1 or 2 companies you want to hold stock in, that's completely fine. The second is ETFs. This is probably one of the key elements of a portfolio. So this is very flexible for diversification. There are ETFs for everything you can imagine, including different countries like China, Japan, or Mexico, different sectors such as gold, copper, oil, pretty much anything you can think of as well, different markets such as emerging or developed markets, and even for bonds and real estate. So it's very diverse, and it gives you a wide array of ideas of what to invest in. The next one is government bonds. So these are the lowest risk of all the investment types. And this is because the only risk is if the country of issuance goes bankrupt. And if you do a US bond, for example, there's very low chance it goes bankrupt. And so due to this low risk, we have a smaller yield as well. So as of today, for the US, a 10-year government bond yields 1.28% per year, and in Canada it's 1.18%. So you can see how inflation might be a problem here, since it's usually around 2%. Overall, they're very good vehicles to reduce risk within the portfolio and keep risk as low as possible. Corporate bonds, on the other hand, is the next asset class, and they're very similar to government bonds in what they are, but they are for individual companies instead of the government. So they're essentially an IOU, which means the company owes you money, and it's to aid in funding, and they're generally higher risk than government bonds. And the last one is the TIPS, or Treasury Inflated Protected Securities, and these protect against inflation and provide the posted yield on top of the inflation value. And this is what we covered before. So this is exactly what we want, because we get that yield and we don't have to pay inflation. So big names in economics and finance such as Jack Bogle, Warren Buffett, Burton Malkiel, and David Swensen all utilize these diversification tactics in the ways and utilizing different sectors, industries, and countries, among other things, to best protect against market volatility. And this is their key to their success long term. So following the structure in this sense will help you build a portfolio that builds wealth over time and helps you build your pension.